American Retirement Advisors with the Gradient Investments weekly talking points for the week ending July 28th, 2022. 2023, excuse me. Let's get into this. Stocks, equities rose across the major global indices with the U.S. benchmark S&P 500 up 1.03% and 20% year to date. The Russell 2000 was up 1.09 and the NASDAQ gained 2.03. Now, overseas, the developed markets, which gained 0.93, while the emerging markets gained 2.86%. In the U.S., the best performing sectors were communications and materials, while utility and real estate were the laggards. And by style, large cap growth and small cap value were the best performers. So it's going all over the place. You just don't know what's going to win any given week. So talk about fixed income. The Federal Reserve Open Market Committee voted to raise the federal funds rate by 0.25%. From 5.25 to 5.5% range. That was expected. We kind of knew that was going to happen. So commentary from the Fed chairman was dovish, indicating that the Fed will wait to determine the effects of the higher rates and tightening credit conditions on economic growth before making its next rate decision. All in all, effort to bring inflation down to 2% goal, which I don't think is going to happen anytime too soon, but we're getting there. The benchmark 10-year Treasury yield rose 12 basis points to 3.96%. And hopefully we're not going to see any more raises. We're going to start to see that come down once everything's kind of settled in. That's the hope. Let's get to commodities. Oil prices rose 4.55% last week to $80.58 a barrel, buoyed by tightening supply, slower inflation in the U.S., and still resilient American economy. Oil is now the highest level since early April, pushed up by the OPEC plus production cuts, which are tightening supply, and meanwhile, demand may set a new record high this year, according to oil executives. So that's, again, highest that we've seen all year, or since early spring. Economic data. The first estimate of second quarter economic growth was 2.4% annualized versus the estimate of about 1.5%, reflecting strength in consumer spending and the best pace of business fixed investment is year over year. So that's encouraging, which is why the market keeps going up. Inflation as measured by personal consumption expenditures, PCE, confirmed further progress on the inflation fight during June. Federal Chair Powell focused measure of inflation, core services, including housing PEC, rose a modest 0.24% in June, or less than 3% annualized, a notable downshift from the previous month. So we're starting to see the efforts raising all the rates. Again, he was trying to get us into a recession to kind of cool the inflation. It's working. So no recession though. Things are starting to tighten up, but still doing pretty good. So going to company news, Alphabet, which is Google, which is a contrarian choice, Core Select, and G33 holding, reported revenue and earnings that beat consensus expectations, including 5% growth in search revenue and 28% growth in cloud revenues, with easier comparisons ahead and controlled costs. Management indicated that revenue and earnings may rise faster than current consensus estimates in the coming quarters. Shares were up 10.5% for the week. How about Meta, Facebook, right, which is a contrarian choice, of course, Select and G33 holding. Shares rose 10.6% last week after quarterly results beat the consensus expectations. The revenue surprise was driven by growth, user numbers, and revenue per user, as well as success from newer initiatives such as Reels and Threads. And management also indicated that growth is poised to accelerate in the current quarter on the easing comparisons. Improved ad products, as well as considerable investments in AI, which is AI is a big thing right now, and they're beginning to pay off. We've seen Meta's up almost, well over 100, just doubled already this year, maybe even tripled. So it's been up considerable this year. So talk about Willis Towers Watson, which is a G50 holding, declined 10.5% after company missed quarterly earnings estimate, and management further lowered its full year earnings guidance due to increased operations expenses and lower returns on their investments. This stock is currently under review. This is where the active manager comes in. If it's not hitting where it's supposed to, we're going to get rid of it. So it's under review right now. And that includes this week market update. Thank you so much for being part of the ARA family. If you need to get a hold of us, please contact us at 855-756-5700. Visit us at aradvisorsinc.com. Make sure to check out our Facebook and YouTube. And if you're not getting our newsletter, share it. And just remember, the market right now is rebounding very nicely from last year. We're already seeing that a lot of our portfolios are up 10 to 20 to 30%, and we were down, remember, last year. So every year one goes better than the other, so we got to be careful not to keep jumping in at the wrong times. That's why we stay equally allocated and we ride it out and make sure, because we're glad we did at this point. God bless you. We'll see you again next week.